Over the last 6 months, Tesla is down over 21%. So in this video, we will go over some news around the stock that has caused this sell-off, as well as look at a famous super investor and how she has approached this company over the last quarter. And finally, we will leave off the video by going over Tesla's numbers and where the stock could be trading by 2026. So if you enjoy the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. So as I mentioned in the intro, Tesla's stock is down over 21% in just the last 6 months, and that's from about its 52-week highs of just under $300. However, keep in mind that Tesla stock a few months ago did trade down to under $200, and it looks like we are on a similar path here today. To find the next level of price support, we have to zoom out to the 1-year chart, and we can see that at the start of 2023, the stock was trading anywhere from around $160 all the way up to around $185. Personally, I think it's difficult for the stock to fall back to these levels. I think the 200 support is probably more likely to where the stock will go. However, we could see it fall down if it were to break through all the way to around the 180 mark. And the only way we see Tesla stock fall down to these levels is if we see a continuation of bad news coming out. Here we can see that Tesla did have some bad news at the start of the year as they have halted production in their Berlin facility. Reports indicate that production is being shut down in the Berlin facility for only 2 weeks and that these halts are directly related to conflicts in the Red Sea. And if you aren't familiar with the Red Sea, it is the waterway located between Saudi Arabia and Egypt. And this waterway is massively important for trade between Europe and Asia. The Suez Canal allows ships from the Mediterranean to travel through the Red Sea, then through the Gulf of Aden and the Arabian Sea to transport goods to India as well as China and anywhere in Southeast Asia. With the Shanghai facility up and running, it's unlikely that Tesla is shipping vehicles through the Red Sea to Southeast Asia. It is more likely that they're trying to receive some raw materials from Southeast Asia, maybe India, that they can no longer get because of these conflicts in the Red Sea. And obviously with the Berlin facility being shut down for 2 weeks, this could create a drag on the business. Overall, Berlin is able to create 375,000 vehicles annually. This is about 15 to 16% of the total vehicle creation that Tesla is capable of. And personally, I don't think these issues will last very long because when we start seeing conflict in the Red Sea, the US military will generally get involved and move ships into the area. One thing the US military can't help with is bad publicity, and we're seeing that a little bit here with Hertz as they announced that they are selling 20,000 electric vehicles to buy gasoline vehicles. Hertz announced on Thursday, January 11th, that the company would be selling off a third of their electric fleet, roughly 20,000 vehicles, and using the money they bring in to purchase more gasoline-powered vehicles. The company cited higher damage repair costs as well as higher depreciation as being two of the main factors for this decision. We also saw the CEO release a statement saying collision and damage repairs on EVs can often run about twice that associated with comparable combustion engine vehicles. CEO Stefan Schur also said that the MSRP declines in EVs over the course of 2023, primarily driven by Tesla, have driven the fair market value of EVs lower as compared to last year, such that the salvage creates a larger loss and therefore greater burden. With that, Hertz is expecting to take a loss of around $245 million due to the depreciation of their electric vehicles. That is about $12,000 per vehicle. Overall, Teslas make up about 80% of Hertz electric vehicle fleet, and altogether, electric vehicles only make up about 11% of Hertz total rental fleet. So there are a couple of concerns here with this news. The first being the amount of electric vehicles that will now hit the market with Hertz selling these off. It is unclear whether Hertz is going to sell these all off in a very short period of time or whether they're going to slowly trickle them onto the market over the next year. But this could cause a little bit of drawdown in demand for Tesla because ultimately if people see used vehicles hitting the market that are Teslas, they could potentially opt for a used vehicle instead of a new vehicle. And that's not to say that there aren't any benefits to this either, because if we see a lot of consumers coming in and buying these used vehicles, they will need battery packs, they will potentially need insurance, they will need repairs. Those are all things that are going to impact Tesla's business, and if they have good experiences with the cars, then they will become long-term customers. So in the long term, this could be a good thing for Tesla. However, in the short term, they will feel some pain. The second issue with this news comes around the repair costs for Tesla. We saw the CEO mention that those costs are about double that of gasoline vehicles, and this could ultimately turn consumers off from buying Teslas. However, what we should see over the next 5 to 10 years is we should start seeing a lot more repair parts hitting the market that are aftermarket parts. parts. And what that ultimately means is general manufacturers coming in, making parts that are in Teslas for cheaper than what Tesla can make it for. And ultimately, this is a good thing for Tesla because it will drop those repair costs and lead to more consumers being open to owning Teslas. And with a series of bad news reports coming out about Tesla, that has created a buying opportunity. At least that's how Cathie Wood sees it, as she spent $25 million on Tesla stock. On Thursday, January 11th, Cathie Wood purchased around 112,000 shares of Tesla at a cost basis of around $127. This is about $25.5 million worth of Tesla stock. And this move comes as Tesla falls back down to its 200-day moving average. And overall, Cathie Wood has done a very good job of predicting Tesla's stock price. We could see that she had a number of purchases prior to 2019. However, even since then, she bought shares in the middle of 2020 and ended up selling out at a very high price. She ended up buying again, even at somewhat high prices at the end of 2020 and early 2021, but she sold 6 million shares at all-time highs of Tesla in November of 2021. And in more recent times, Cathie Wood bought the dip at the end of 2022 and ended up selling out of shares as the stock ran up throughout 2023. And clearly, Cathie Wood sees today as another potential buying opportunity. And part of Cathie Wood's buying probably has to do with the strong metrics behind the company. We could see that at the end of 2018, the company was bringing in around $21.5 billion of revenue. Here today, that number has grown all the way up to $95.9 billion. The only concern that I see with these revenue numbers comes around their most recent quarter. Their growth year over year was sitting at only around 8.8%. If we look over the last 4 quarters, their growth year over year has been anywhere from 24% all the way up to almost 50%. And this is kind of to be expected. The fact that they have continued growth is very, very important because we have seen a very weak car market. However, I would like to see over the course of the next year, as interest rates potentially drop, this growth continue to get back into the 20+ range. And Tesla has seen very impressive net income growth over the last 5 years as well. They didn't really start bringing in quarterly positive net income until 2018. However, their year-over-year net income didn't turn positive until 2020, where they brought in around $0.37 billion of positive net income. From there, it's grown all the way up to a trailing net income of $10.8 billion. And right now, net income is trending in the wrong direction. We can see that in their most recent quarter, they experienced a year-over-year change of minus 43%. This is down in a massive way from what we saw a year ago of around $3.3 billion in a single quarter. What I'd like to see Tesla do over the next year is start getting their net income back up and trending towards a trailing 12-month net income of around $12.5 billion. Here's basically those same numbers on an EPS basis. We could see that their all-time high of trailing 12-month EPS was sitting around $3.62. However, now it's down to around $3.11. And one thing you can't ignore is stock-based compensation, because this dilutes investors. And what we saw at the end of 2019 was shares outstanding sitting around 2.6 billion shares. However, today that number has grown all the way up to around 3.5 billion shares outstanding. And personally, I'd like to see Tesla start issuing some buybacks to start bringing their shares outstanding down. One positive is over the last year and a half or so, they haven't really increased their shares outstanding in a meaningful way. However, it would be nice to see them buy back their own shares and start bringing this number down, especially when the stock is on a dip. After going over all of those metrics, let's go ahead and make some price predictions on where the stock could be trading by 2026. Let's start by taking a look at 2023. And for net income, we have a prediction of around $12.2 billion. This will be a little bit difficult because they will have to have a massive fourth quarter. However, we have seen them hit these numbers in the past. For shares outstanding, we are sitting at around 3.5 billion shares, and this brings our EPS total to around $3.49. And if we take a look at analyst expectations for 2023, they currently have an EPS target of around $3.15. So this number would be on the higher end, but still below the highest EPS estimate of $3.60. And then what we are projecting for 2024 is around 10% growth in terms of net income. That brings our number up to around $13.42 billion of net income. We're predicting around a 2% increase in shares outstanding to around 3.57 billion shares, and this brings our EPS number to $3.76. And this is right in line with analyst expectations for 2024. The average estimate is sitting at $3.78. We have a low estimate of $2.41 and a high estimate estimate all the way up at $6.17. And in 2025 and 2026, I started increasing net income growth to 15% and 20% respectively. The reason for this has to do with interest rates. If we start seeing the Fed dropping interest rates like they are proposing, they're trying to get down to around 2.5% by 2026. And if we start seeing that, that means that there could be a lot of demand in those years as cars become more affordable because of the loans and interest rates being lower. So this brings us to a net income of around $15.43 billion in 2025 and $18.5 in 2026, with shares outstanding again increasing around 2% each year to around 3.6 in 2025 and 3.7 in 2026. And this brings EPS numbers to $4.24 in 2025 and $4.99 in 2026. So for this next section, we have to make predictions on valuation. And what we have done is we have set up a range. So a range of PE ratios anywhere from 45 all the way up to 70. And we can see that right now Tesla is trading at a trailing PE ratio of about 70 and a forward PE ratio of about 62.5. So keep in mind that these EPS numbers are trailing 12-month EPS numbers. So what that means is the trailing 12-month PE ratio probably makes a little bit more sense of 70. However, what I have done is I have highlighted 60 because generally what you see is 60 as being the max that a lot of investors are willing to pay for companies. So what that means is a fair valuation right now for Tesla is probably around $209. In 2024, that number jumps up to around $225, then $254 by 2025, and $299 by 2026. And I've even gone in and calculated the compound annual growth rate for these 3 years. And what we can see based on the current price of around $219 is that if you only held for 1 year, you'd get a return of around 3%. If you held for 2 years, you'd get around 7.7% compound annual growth rate, and then about 11% in 2026. And I've also ran these returns if the stock were to drop down to around $200. In my opinion, I think $200 is where Tesla starts getting interesting, because what we could expect for a 2024 return would be around 12.7%. That would stay about the same through 2025, and then it would jump up to around 14% by 2026. So keep in mind that all of these numbers down here are compound annual growth rates. That means this is the return you could expect each year over that holding period. So you would expect a return of around 14% for 3 years. And that's important to keep in mind. It's also important to keep in mind the assumptions that are being made. Again, this is assuming that Tesla will trade at a 60 PE ratio and that net income will grow at these rates and shares outstanding will hit these numbers. So personally, I think Tesla starts getting interesting below that $200 mark, but really I'd like to see it go down to around 175, and that's where I'd like to get an entry point. That builds in a little bit of buffer room in case any of these predictions are wrong. But keep in mind, do not buy a company just because some random guy on YouTube talked about it. Do not buy a company just because Cathie Wood bought it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. With all of that said, I hope you enjoyed the video. If you did, make sure to drop a like down below. And if you want to see more videos like this one, subscribe. And as always, guys, have a wonderful rest of your day.